Hello, and thanks for listening to another episode of Your Life Simplified. My name is Brian Leiter, and I'll be the host of this podcast. In this episode, we're going to talk about year-end tax planning because we're getting close to the end of the year, and we still have some time to improve our overall tax situation, which will obviously help improve our overall financial situation. So to join us today for some tips and tricks on how to reduce our taxes before year-end, we have Ryan Drake here, and he's a CPA within the Mariner Wealth Advisors organization. So Ryan, thanks for being here today.
Yeah, happy to be here. Always glad to talk about year-end planning ideas.
Always interested in saving taxes for yourself and others, I'm sure.
Oh, absolutely.
Hey, so first of all, congratulations, right? You got through a pretty lengthy tax season. How you doing?
You know, the last almost month has been really nice. Forgot what life felt like after this last year of tax reform changes, a bunch of other things. So it was a brutal year for a lot of us in the industry, but I think we're all recovering nicely.
Yeah, I know you guys were burning the midnight oil, so clients and others appreciate all the work you guys are doing. So thank you for your time. So Ryan, I know when you review tax returns, you're obviously going to find mistakes and opportunities, and let's talk about some of those mistakes. What are some of the common mistakes that you saw this past tax season with folks?
Sure. I think despite the new tax reform, some common things carried over from prior years, just little things like whether or not Form 2210 was filled out, which is an underpayment of estimated tax penalties. If you don't meet certain requirements for estimated taxes, you get charged interest and penalties. It's one of my favorite things I like to look for and is a quick way to prove and justify my fees to clients, because I can save the money just by doing what is right instead of reactionary tax planning.
And just to be clear, that's when there's, maybe I didn't withhold enough inside of my paycheck or in my payroll taxes because I own my own business and things like that. If I didn't withhold enough on a quarterly basis, I may owe a penalty, I may owe things of that nature, correct?
That's correct. And actually, that's a great point, because what we found this last year was almost everyone was in the wrong. The IRS, when they did the payroll withholding table, somehow something got messed up, and what everyone started finding in the big nasty news articles that came out were half of America is underpaid on their estimated taxes, and everyone went, well, I just have a W-2, right? Like, I'm never underpaid.
It's not my fault.
It's not your fault. And there was thankfully some relief that Congress passed, or the IRS allowed, that kind of made up for that to a degree. People still owed the tax because it was due, but they got rid of the penalties. This underpayment of taxes and estimated taxes is really everyone's involved, and it is as simple as, am I getting enough of my payroll withholding done right throughout the year? And that's a great point. And going into 2019, that's a wonderful thing to look for, because the payroll tables haven't changed. And the W-4, which is the form you fill out when you are considering what withholding you want out of your wages, hasn't changed yet. They are talking about updating that form by the end of the year, but that will be a forward-looking change. So 2020 would be different. But if you found yourself a little surprised, let's say with your April tax bill, and you're just a W-2, not just a W-2, but you traditionally have maybe a W-2 and maybe a bank statement, and you're traditionally over withheld, it's probably a great time to actually get that most recent pay stub, look at it compared to where you're at last year, and see where your withholding is falling out.
And depending on the way in which you're paid W-2, maybe there's some variable compensation and things of that nature. I mean, how often do you want to review what your withholding looks like? Just because you don't want to owe too much, you don't want to pay taxes, and at the same time, you don't want to give the government an interest-free loan. What do you generally recommend?
That's a great question as well. So pay varies based on what you do. For the typical salaried employee or hourly employee that is maybe getting a year-end bonus, I would recommend maybe in June taking a pulse, and in November taking a pulse again and just seeing where you're at. If you're on a variable pay schedule, such as a commissions-based consulting or sales or otherwise, or getting maybe quarterly bonuses, you probably want to do a withholding check every quarter, let's say, just to make sure that your increased income is being withheld on enough.
That makes sense. And that's just, again, that's being proactive with your overall tax situation. And that happens to be withholding, but there's many different areas. And I know what I find is, people are really proactive as it relates to their investment plan, but they're not proactive as it relates to their taxes. I mean, they think it's a one-time event, whether that be maybe April 14th for them because they got to get everything in by April 15th. But the reality is it's more of a year-round exercise, right?
I would totally agree with that. I think I've had enough conversations with my friends and others through the years that I've really come to understand taxes are basically the financial equivalent of going to your doctor, right? Like, you should go whenever you notice a change in your life, but you should really go at least once a year for your annual checkup. They might poke, they might prod, and send you on the way with a clean bill of health, but that's better than being caught unaware or surprised.
You bet. Appreciate the analogy. It's great. What other mistakes have you seen?
So I think as we talk about mistakes, I've also seen a lot of equity award-based mistakes in compensation and the subsequent disposition of those awards. And so it seems to be an increasing trend, which is wonderful, where employees of publicly traded companies such as Starbucks or Comcast have these equity awards that roll through their payroll. And without getting too technical in that, it triggers a tax event when they're awarded or when they vest, and then it's a tax event when you sell them. And if you are preparing your own taxes, or if your CPA is not paying close enough attention and just taking what the broker statement says at face value, sometimes we miss this bump up in tax basis that ran through your W-2. And so I was just reviewing return a couple weeks ago as a prospect, and within probably 5 minutes, another quick check I do, other than the estimated tax penalties, is look at capital gains. It's as easy as, what are your proceeds? How much of a gain are you reporting? If I see something that's doubled in value, I always try and figure out what stock it is. And then if I notice that that stock is where that person is employed at as well, I always ask the follow-up question, hey, was this gained from an equity award? And in this case, it's probably about $60,000, $70,000 of tax savings from an amended return that'll probably take me 20 minutes to do.
Yeah, that's terrific. Right, I know you and I were in a meeting not too long ago with a client, and there wasn't necessarily an error in the awards that they were receiving for the company, but there was an election that you guys were able to put together as a strategy to really convert some of this ordinary income to capital gain. And so I think that's really interesting, where you guys can recognize not only the mistakes, but the opportunity on how to further the benefit that the company is really giving these individuals from a tax perspective.
Sure. And I think just as a general highlight on why it's important to be very active with your tax situation or your financial plan, it's equally as important to have everyone talking to each other. So in these instances, if your advisor for wealth isn't the same as your advisor for taxes, making sure, or you have multiple advisors in the wealth sphere and tax sphere, that every party is brought to the table annually to talk about who's doing what levers are being tripped, and so that these things can get worked out. And we don't have, let's say, broker A selling a bunch of tax losses and then broker B waiting until the following year to recognize gains, because they think it helps out in some situation.
Yeah, that's an excellent point in terms of harvesting losses and so forth. If one advisor is buying X and the other advisor is buying X, you have a potential issue regarding the wash sale rules and now losses that they may not be able to deduct.
Absolutely. It's a very tricky sphere, and what I always joke with people that talk to me about their taxes are, it may look simple on a 1040, but it gets complicated really quick.
Hey, this is Scott Sturgeon. I work on the team that makes Your Life Simplified a reality. We'd love to have more information on our listeners so we can ensure that we are tailoring content to what you're interested in. For the next several episodes, we are going to give away a pair of Apple AirPods. Being considered for the giveaway is easy. Simply email your age, state you live in, and 3 topics you'd like us to address in the future to podcast@marinerwealthadvisors.com. We will pick a winner at random during the next several episodes from those who email us. Again, email your age, state you live in, and 3 future topics to podcast@marinerwealthadvisors.com. And now, back to the show.
So Ryan, thanks for hitting those. And I would tell you that, I think the biggest one that we generally see, or a really common question that comes in from folks, is effectively letting the tail wag the dog, right? So it could be, look, I just don't want to pay taxes, so I need to buy another house. I don't want to pay taxes, so I need to invest in something that's going to give me some massive deduction. And the reality is, I think it's important for everybody to take a step back and say, does this investment make sense for me and for my plan? But obviously, that's a common one that I know you guys deal with quite a bit. I know advisors deal with quite a bit. So as it relates to opportunities, what should we all be thinking about right now?
I think that for year-end planning, there are a lot of different opportunities you can look at. Traditionally, you have wanted to do an analysis on, should I prepay my fourth quarter estimated taxes by year-end and move up that deduction? There's a school of thought that thinks maybe, depending on your itemized deductions, you should try and accelerate a mortgage payment to get the most out of one year's itemized and maybe standard deduction the next. Since the tax reform DAFs, donor advised funds, and charitable giving has continued to be a large item of concern. Roth conversions continue to be a very important topic, and there's a lot of reasons for that. But as we go through all of these, I think those are the biggest areas of concern, but it can be anywhere from should I get married this year to next year, all the way up to should I sell my business.
How do you go about understanding what that opportunity is for each of those? So, one of them you mentioned, should I prepay my mortgage? I mean, what are some of the things that we should be paying attention to?
I approach life on a pain tolerance level, right? So as I think about year-end
It's a great outlook on life, by the way.
Yeah, well, I mean, I'm jovial at times, but I'm a realist. So anyway, I approach this on a pain level tolerance spectrum. So if I go into my year-end plannings and my year-end analysis, I'm going to look for the quick fixes first, right? And that's, am I at my real estate and personal property tax limit, state incomes, otherwise known as SALT, on your items and deductions. If I'm under $10,000 between my state income taxes, my real estate tax, my property taxes, maybe I look at prepaying my real estate tax to get up to the $10,000. If I am right on the cusp of having enough mortgage interest and real estate taxes to deduct to get to an itemized deduction, and I haven't been charitable this year, maybe I think about throwing $1,000 just to make sure I get into that. Or I knew I was going to do $5,000 in February. Can I accelerate that into December? That way I can get the most out of my deductions.
And just to be clear for folks that are listening, I mean, again, you're getting the greater of the standard deduction or whatever your itemized deductions are. So that's sort of the game that you're trying to play, right?
That is correct. And so, the tax reform has just changed so many things, and everyone's probably well versed in it by now, but standard deductions basically doubled. So it used to be fairly simple to get to an itemized deduction if you had, say, a mortgage. Now you're finding that with the SALT limits, the state and local income tax deductions, real estate, personal property, state income taxes, with the limits on that and your mortgage interest, you're not always going to be at the new $24,200 of standard deduction that a married filing joint couple gets. So without additional charitable deductions or investment interest expense or a few of the other ways you can itemize the deduction, a lot of America is now falling into standard deductions.
Yeah, I think the stats were 90-something% of people now take the standard deduction, which is interesting unto itself. A couple of things you mentioned. One of them was the SALT limitation, right? The state and local taxes. So, thinking about that, I think about the $10,000 limitation you can have on real estate taxes. You think about the states in which where real estate taxes are sky high. I mean, obviously the coasts jump out and things of that nature. I know that some of these states have come back and said, hey, we're either trying to repeal this or try and find a workaround. Is there any update on that? Are we still subject to this limitation?
There's been a lot of gamesmanship is what I would say.
It's a great word.
That I won't get into all of it, but a gamesmanship that has been played through the last year, as clever and fun as trying to establish charitable funds that you give money into, and then you get an offsetting credit back for your taxes owed for real estate taxes. And it's been very interesting. The IRS isn't buying it. They're simply not. They've shut down a lot of those and said, no, guys, this just isn't going to work. So I think the update is we're stuck with it. 10,000 is our max for now until Congress decides otherwise, or 2026, I believe.
Yeah, that's actually driving a decent amount of folks from relocating out of some of these states into some of the other, the havens, if you will, from this perspective. So I know Florida's been a big beneficiary of that. And a few well-known celebrities have recently moved out of the greater, New York City area onto Florida and things like that, trying to then improve their tax situation. It's a raise, or it's a right away. It's an improvement to their overall financial picture. Some of these celebrities probably don't need those additional funds, but for others, and if anyone's interested in that and changing your domicile, we did a podcast a few months ago on that if you want to go back and listen to that. But one of the other things you mentioned was the Roth IRA, and I think that there's a lot of misinformation as it relates to the Roth. I personally think the Roth IRA is probably one of the best accounts you can possibly hold. But talk to us a little bit about the Roth conversion.
So a Roth conversion is more than just an IRA. It can be that, or it can be a Roth 401k through your employer. The idea here is you're basically saying, look, I have enough tax-deferred assets in my traditional IRA or traditional 401k account. I would like to recognize some of that income now in the hopes that it grows tax-free and comes out tax-free later. So your traditional 401k is tax-deferred growth, but taxable on distribution. Your Roth accounts are tax-deferred growth, but not taxable on distribution because you tax them before you even put them in the account. The conversion is a process where you look at those accounts and you say, I'm going to move $50,000 from my deferred account into my tax account into a Roth. There are some tricks that you want to do there. The basic principle is rate arbitrage. You're trying to look at what marginal bracket you're in and make the absolute most out of that without clipping into the next one.
It's also playing where you think tax rates are headed, right?
Sure.
So I remember the 70% tax bracket. I mean, it wasn't that long ago that we had that. And I don't know if they were headed there, but I mean, rates today are so low that most professionals suggest that they're going to be up in the future. So the reality is that taxes are effectively on sale. So to do a conversion, everyone's situation is a little bit different. But if they believe that they're going to be at a higher income tax bracket later on, and then want the ability to legally manipulate their taxes later, we talk about diversification as it relates to investments, but probably not often enough do we talk about it from a tax perspective. So a lot of folks over the years have put so much money in their tax deferred accounts that when they're forced to take these distributions out at say 70.5, they're just whacked. And they don't have enough leverage at that point to manipulate their taxes. So I think the Roth IRA strategy, the conversion itself is a great strategy, although it's not for everybody. Mm-hmm. And you'll have to pay particular attention to what other types of accounts you already have, because there are some aggregation rules that need to be followed. And there's sort of a lot to that, but it can be a great strategy for individuals.
I would agree. I think I would tack on just a few things to that. One, manipulate's always a fun word, right? So we're not really manipulating a situation. We'll keep it a little more PC, church it up, if you will, and say that we're just maximizing a situation.
It's a great idea.
Same M word, different meaning, I guess. But along the Roth conversions, where it gets sticky is people can get lost in that, I'm in the 12% bracket. I've got $30,000 to go before I clip into the next bracket. I'll just do it. And what I always like to do is take a step back and go, well, Roth conversions look different in your early 60s than they do your late 60s. So in your early 60s, you might be on the ACA, early retirement. You have enough assets that you're not drawing from your IRAs yet, but maybe you're on Social Security. So if you are in a fixed income situation and you start to bump up that income level, you're increasing your adjusted grossable income. And that can just get you into trouble quick, especially with the taxability of Social Security benefits. Suddenly what was tax-free is now taxable. And that takes that same 12% hit and from a marginal to an effective rate bumps it sky high. You can also get into people that own rental properties. And if you own rental properties, they're wonderful investments from a tax side of life because they're tax sheltered because of depreciation and deductions. But they also have complicated rules around deductibility of those losses, one of which is your AGI level, your adjusted gross income. So if you get your adjusted gross income too high, you can start to lose those deductions. Again, another example of, well, I thought I was in bracket X, but really that marginal rate isn't what's being taxed anymore because I'm introducing more income to it.
Ryan, those are great points. And this is where it's a little bit different than just the headline of, I should have a Roth, or Roth conversions are, this is what I should be doing right now. I mean, it impacts, like you said, Social Security, Medicare premiums. There's a whole handful of stealth taxes, I would say, that are triggered based upon this. So I think, again, you don't have to do it all at once. And so having a multi-year approach, regardless on whether you're going to do this conversion or not, is just incredibly important because, again, taxes are going to impact all of the areas of your overall financial plan. Hey, Ryan, just a couple more opportunities maybe before the end of the year that we should be thinking about.
Yeah, I think that one of the items we haven't talked about that is tremendously important is the idea of a qualified charitable distribution from your IRA account. And those are only available when you hit 70.5 and get to that wonderful level of required minimum distributions. A lot of acronyms going around, QCDs from the RMDs. But the idea is instead of taking income from my IRA that I have to take because I'm 70.5 and required to now, I can instead direct my trustee over that money to send it directly to a charitable organization, whether that's my church or Big Brothers Big Sisters or any other organization I want to promote. And there's tremendous benefits to that. The first is, again, going back to adjusted gross income. We always want to be mindful of this number. It impacts so many things in our life. And this is a great way to manage it. The income never comes in, so I don't have to worry about my AGI going up. I also don't have to worry about whether I'm itemizing or not, because charitable contributions are an itemized deduction. And if I don't meet that $24,000 limit, then I'm not actually getting benefit from my charitable contributions. But this is just still getting that benefit because it never hits income and it's still funding my charitable desires.
So that is a huge point because I think people are under the impression now that when I give or I donate, I can't take the deduction. And the reality is this is an opportunity to do just that, and it has nothing to do with itemized deductions. And therefore, they're able to take that deduction irrespective of whether they're taking the standard deduction or they're itemizing their deductions.
That's right. It's really not even a deduction. It's just never even income to consider.
So is there a limitation on this in terms of a dollar threshold?
There are limitations. There's some important ones. So the dollar threshold is $100,000 per individual. So if you are fortunate enough to have over $100,000 of required minimum distributions, you are capped at that. Your spouse would also have their individual cap as well. There are some other stipulations. You can't give it to a donor advice fund. It has to be to the organization directly. And the other thing I'd really like to touch on that I think gets overlooked is the Medicare premiums. This is a great way, again, because we're monitoring AGI, that we can get benefit through our Medicare premiums. And people after 70 and a half generally have those type of things to worry about.
You bet.
So I know, Brian, that another area that we've talked about recently is the idea of gifting, setting up that legacy fund to the next generation or two. I think it'd be fun to kind of talk about what we can do by year end to establish those gifts. One area that I always see is people love to give money, but is money actually the best thing to give in all circumstances? What are your thoughts on that?
Yeah, I mean, most people do give cash, and I think it's one of the worst assets to give for a variety of different reasons.
I think I can agree with that. I believe that giving stocks can have a large benefit. It limits your estate. It gets the appreciation into the next holder's hands. Depending on if you do dividend-paying assets or interest-bearing assets, that gives them not only the value of the gift, but the earnings that go along with it. Now, that kind of trips into another category of an expanded kiddie tax realm, which is more alive today. If your child earns so much of unearned income, they have to pay their own taxes on that.
Sure. Now, caveat to the cash, or we talked about the difference between giving cash to a charitable organization versus children, but I do love the idea of giving cash to those children that have earned income. Because if they have earned income, they're able to open up an IRA. And maybe they're able to open up a Roth IRA, assuming that they qualify for that. And so, to be able to, supplement in some way, I mean, maybe the children will, I don't know a whole lot of young kids that are that just started working, that are going to want to put all their money into a Roth IRA. And we've seen parents that will match a certain dollar contribution to the Roth. But obviously, we all know that if time is on your side and the earlier you can invest, the greater you'll have later on. And so, putting several $1,000s a year even, just over a 30, 40-year period, we have folks that are, attaining the age of retirement with maybe $1 million in there, depending upon how much you're putting in and the projected rates of return. And so I do think that's an interesting strategy. Again, it's a way to teach kids about delayed gratification, the importance of savings, investments, and things of that nature. So I do think that's a great strategy.
No, I agree with that, Brian. And I think that really touches on one of the things that we value here so much, and that is education, right? Any conversation I go into, I don't just want to tell you what the diagnosis is. I don't want to tell you what the prescription is. I want to tell you how to identify it going forward and how to learn from it and or be better with it in the future. And I think this is a great point on not getting into too much parenting, but how do we raise our kids to understand what money is? Is money a tool or a toy? And if we can get them financially literate at a young age, saying the responsible, prudent thing to do is always get used to some kind of money going into a retirement account, I think it just sets them up for the future so much better.
I couldn't agree with you more. The other strategy we see quite a bit is through philanthropy. So you mentioned donor advised funds earlier. It's a great way to get your kids involved in understanding how money works. Maybe it's a family value on why we support these organizations and things of that nature. Another great tip. I really appreciate it. Ryan, we're almost out of time here today, but I want to thank you for the advice. Hopefully the folks that are listening can heed some of this advice and take advantage of it with a few weeks left to go before the end of the year. So again, thanks a lot for coming in.
Always happy to be here.
We know that your time is incredibly valuable, and we hope you find this podcast a worthwhile investment of your time. Thank you for listening.
Mariner LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor. Registration of an investment advisor does not apply a certain level of skill or training. MWA and its representatives are in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in a state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. Visit www.marinerwealthadvisors.com for additional disclosures. Mariner LLC, doing business as Mariner Wealth Advisors, will be giving one pair of Apple AirPods per episode to Your Life Simplified following the initial run date of this commercial, provided that there are submissions to choose from. Winners will be selected randomly. Each winner will be emailed to notify of the award and will be asked to provide a mailing address to mail the prize. The email address submitted will be subscribed to Mariner Wealth Advisors communications, including, but not limited to, our newsletters and email campaigns.